Dear friends, we're going to close the day with what I think will be one of the most interesting panels of the day. We had with us the institutional leadership of the industry. Then we had the global heads of ship finance, capital markets. I mean, we really had one summit after the other. And now we're closing with an investor summit. The panelists who are going to be with us, and Panos Katsambas of Reed Smith is going to moderate this panel, they are very significant either operators in the market or investors with significant positions in shipping companies across the various segments. So they will tell us how they look at the markets, how they make their investment decisions. I am so amazed that I was able to convince them to come, and I can't thank you enough, gentlemen. Thank you very much for closing our forum with a bang. Thank you.
Thank you, Nicolas and Olga, for inviting us today, and very pleased to be closing what appears to be a very well-attended conference. We know it's the last panel before the drinks, so we'll try to make it as entertaining and give you something to talk about at the reception. I'd say, I've done this panel at many events over the years, especially with Capital Link, and I remember the days where we were talking about the distress in the market, non-performing loans, funds circling around for opportunities, and restructurings and the likes. But the last few years seems to be a rather different market. One that has enabled far greater returns and opportunities for the traditional shipping investors. Institutional investors still play a very significant role, and we're going to examine today where the opportunities lie, what type of trades, what type of sectors, and in this environment where geopolitical changes, sanctions, regulations, environmental laws, etc., play a big impact in both in the cost capital and the operational side of the businesses. We will also touch upon how these impact capital allocations and investment decisions. We have a great panel with us comprising of fund managers, institutional investors, operators, and owners. And I would like very briefly to have each of our panelists introduce themselves, and then we can kick it off. Christian?
Thank you, Panos. So, Christian, Synetos. I'm part of a team at BlackRock that invests into the infrastructure sector. So infrastructure for us means energy infrastructure, natural resources infrastructure. It means transportation and logistics infrastructure. And it also means digital infrastructure. That's how we've defined our mandate. In terms of the marine space is a sector that we have invested into historically and continue to invest into, but with certain parameters that we typically solve for. So we look for, as an infrastructure investor, we look for a certain degree of downside protection, which in this industry you only get through contract cover, and that means that a big chunk of the shipping market is not really in scope for us. So, but a certain portion is in scope, and that is the part of the market where medium to longer term contracts are available, are possible. In terms of the investments that we've made in the broader marine space, the first investment that we made was actually back in almost 10 years ago in 2014, where we invested into a portfolio of FPSOs in Southeast Asia, which worked quite well for us. It was a long-term contracted infrastructure investment, critical infrastructure for the oil and gas producers, and there was not much residual value reliance. Contract extensions were upside. That was our first adventure in the marine and the maritime space. Much more recently, in 2021, and I'm sure most people in the room are aware of this, we took private GasLog with the support of the two key existing shareholders, and that means that we now since then have a a presence in the LNG shipping space as well. Those are the two main investments in the marine space. But going forward, it is a market that we're actively looking into. But again, looking for contract cover and of course long-term trends that are supportive, which we'll talk about later.
Thank you. Yeah, absolutely. We will touch on that. No, pleasure. Vagelis.
Thank you, Pano. Good afternoon, everyone from my side as well. Thank you for staying so late with us here. My name is Vagelis Chatzigiannis. I work with GMS. GMS is the world's largest cash buyer of ships for recycling, ships and offshore assets in particular. GMS has executed, since its incorporation in '92, more than 2,000 transactions on that front. In the past few years, we have decided to expand further in the ship owning side with 𝘏𝘪𝘨 Global, which is currently operating about 40 vessels, varying from small handies on the dry front up to capes. Most of our dry tonnage actually is in the cape segment, but simultaneously also diversifying through chemical tankers, containers, and so on. Thank you.
Thank you, Vagelis. Very nice to have you here today. Over to Darren.
Hi, Darren Maupin. I'm the founder of Pilgrim Global, which is a distressed hedge fund, and also founder of Anglo International, which is a dry bulk ship owner, privately held. We're generalists. We've been involved in shipping, in conventional shipping sectors starting in 2016, and have moved across dry bulk, container ships, and tankers and wet in various public and private structures. And we're working now more with offshore.
Thank you, Darren. Peter?
Peter Weernink, founder of SwissMarine, dry bulk operator, pure specialist. Core of our business is and has been trading of dry bulk ships. We currently run about 200 ships from Ultramax to Capesize. Recently, we also tried to use that knowledge of this specialized industry in investing more in the dry bulk space. We're becoming a small ship owner, and we're investing in both private companies and in listed bonds and shares in our space.
Thank you. And over to Nicolas, and I'll also ask the first question for Nicolas following his introduction so that we can get going and see at Tufton how they position their funds today, both on the listed and the private side in terms of the opportunities. If you can start with the initial commentary on that.
Sure. Thank you, Pano. So I'm Nicolas Tirogalas. I am the CIO and president of Tufton. Tufton is probably the oldest investment manager with a specific mandate to invest in the shipping and offshore space. So we have today, over time, we have invested a lot more capital. Today, we manage about 1 billion in equity. We have about 45 ships in our various public and private investment mandates. We haven't even announced that, we have recently raised significant new pocket of capital, which is going to be somewhere between up to 1 billion in equity, which is meant to invest in green transition. Of course, we're not the first ones to say that, but that seems to be the appetite of the investors these days. And like what Christian was saying, it's around yield and around cover. When it comes to your question about, we have two publicly listed vehicles, income trusts, one in the UK under the ticker SHIP and one in Norway, which IPO'd, and a lot of people previously in other panels talked about difficulty in sort of new IPOs. We actually IPO'd a company last year with a small fleet of 7 chemical tankers. Today there are 9. Since IPO, including dividends, the stock is up about 20% in Norway. So liquidity may not necessarily be there. However, the ability to raise some money in the private markets for what I think one of the panelists was saying before, a differentiating strategy is possible. And the uniqueness of stainless tankers is the fact that there was no other vehicle out there to profit from a pure chemical tankers exposure. And SHIP, which is our other investment vehicle, that's more of a diversified fleet. We own tankers, we own gas carriers, we own dry bulk carriers, and we also own multi-purpose vessel. But with regards to the private versus public, which is the question that you asked, you know, we have seen, depending on the sectors that perform well, as I said, today, you know, chemical tankers are up 20%, they're trading a lot closer to NAV. The diversified fleet in the UK, it is trading at a discount to NAV, but that's probably a factor more of where the income trusts space in the UK lands rather than, you know, the sort of portfolio itself. With the private vehicles, you don't have that exposure. You don't have to deal with investors. Yesterday, I was meeting with institutional investors that, you know, were raising the issue of the discount. You don't have that on the private markets. You realize NAV, people see that return, and whereas at SHIP, we're at 13.9 net IRR since inception over a 6-year period, people still talk about discounts to NAV.
Sometimes discounts to NAV in listed companies is okay because it brings a bit of fun for us to watch in the media and various situations that play out. So, but let me switch to Darren, and you mentioned about stress and distress strategies, and I wanted to, do you see any opportunities for a counter-cyclical strategy today, or are you pivoting in different types of investments?
I guess the first thing I would say is that in a super cyclical business, the only path to success is to be counter-cyclical. And shipping is probably the most cyclical business on earth. The real question is there anything to do in that way? We tend to be, you know, really at the bottom when things are ugly. So we have very little left in traditional shipping. We still own a private dry bulk vehicle, and for a variety of reasons, we think dry bulk looks really good. But we've really pivoted to offshore the last year and a half, where we have been able to really invest in, you know, in the midst of bankruptcy, post-bankruptcy, and capitalizing on distressed sales, post-bankruptcy type sales. So that's still where we see the most limited residual value risk, the biggest discounts, 0 order books, and really positive dynamics. Traditional shipping, there's nothing particularly wrong with wet and dry in particular, but we've kind of moved on.
And do you position yourselves to, you know, kind of predicting or looking at when the next cycle opportunities will come along, or will you opportunistically raise capital when that moment arises? How do you position yourself for the future in that context?
We're purely opportunity driven. We don't sort of say in 3 years there's going to be a problem over here and therefore we should raise a fund for it today. We just deal with what the world gives us, with what the market gives us. Today it's offshore.
Perfect. Christian, switching to the opportunities, you mentioned some investments that you guys have done over the years, but today within the bucket that you mentioned across infrastructure, transportation, how do you allocate within those broad sectors opportunities? Is transportation always playing a role, or you compare it to the opportunities you see more on the traditional infra space?
Yeah, and so I think it's helpful to just go back to sort of, you know, first principles around how we think about investing, which is a very long-term horizon. We are a 12-year fund. We typically underwrite our investments to a 10-year hold. But when thinking about residual values post that 10-year holds, we take into account the remaining, you know, asset life in this case, or the concession life in other sectors. So it's a very long-term approach, and that means that we also, when making investment decisions, we always think about the very long-term trends. We are less fazed by shorter-term volatility. Our mandate is not to benefit from short-term dislocations. It's very much a long-term mandate, more income-driven. And if you can position your investment in such a way that it can benefit from capital appreciation at some point in time, that is great, but it's never our base case assumption. So we're much more driven by long-term trends, and then I guess the question you're asking, or the way I should interpret it, is what are the long-term trends that we're looking at? So one of them is, I think, is obvious: energy transition. Right? Energy transition is in everyone's is on top of the agenda for everyone. I think the more interesting question is, what does that mean in terms of opportunities, investable opportunities in the marine space for someone like us? So I do think you have to think about hydrogen and increasing flows of hydrogen, what that means. It could mean investing in ships that can transport hydrogen. It can mean investing in ships that can transport hydrogen in other forms, like, for example, ammonia. The emergence of the carbon capture and storage industry is, we're witnessing it at the moment. That will create opportunities in the marine space as well. And it's beyond, for us, it's beyond ships. It's not just the vessels. We're also looking at the supporting infrastructure, for example, the terminals, and potentially even the production and storage facilities. So we're looking at the whole value chain. So energy transition is one big topic. Then I think the other big topic, maybe that emerged or increased in importance more recently, is energy security. If you think about energy security, you very quickly, especially with a European hat on, you very quickly think about gas, natural gas, which can mean LNG. It can mean, or LNG shipping, it can mean regasification terminals, it can mean liquefaction facilities, so that whole value chain. Because energy security doesn't just mean geopolitical energy security, it also means being able to live with increasing amounts of wind and solar generation on the grid, and gas can play a role there as a transition fuel. So that's the second key topic. And then I would also say, deglobalization is something you have to think about. And that could mean that certain sectors that have historically benefited from increasing trade flows are now perhaps, you should look at it with a bit more caution. In the shipping space, perhaps that's containers. So those are maybe the long-term trends. You could go further down the list, think about things like alternative finance, alternative ways of funding that are emerging as banks are pulling back from hydrocarbons in particular. That opens up opportunities, creates opportunities for investors such as ourselves. For example, in the leasing space, which is something that fits more naturally with an infrastructure fund. But those are the long-term trends that I would highlight.
And let me ask you, I mean, these are the trends that drive the investment from investment strategy, investment objective, and macroeconomic situations. How do you go about at BlackRock, a huge institution and asset allocator, in terms of finding the targets within those sectors? And what are the things you're looking for in the companies, operators, joint venture partners, and so forth that you guys invest in?
Yeah, no, we're very much driven by themes, thematic investors. So, we have done deep dives on hydrogen, on carbon capture and storage, on natural gas, on ammonia. And the way we typically go about it is we would get smart on the macro, first of all, to convince ourselves that it's the right macro to be spending time in, and then we'll do a mapping of all the key players across the infrastructure space. And for us, we would typically only want to speak to the top 5 or so names in the space, because what is important to realize, with a closed-ended fund, you always have to think about exit and how you exit an investment. It can look great when you're entering, but if you can't exit it well, it's not going to be a good investment. So in order to create that exit value, it's very much about quality of your, in this industry, charterers, quality of your lenders, quality of your joint venture partners, operating capabilities. You need to put all of that together in order to create something that is differentiated. And that's what we look for, and that's what we look to also to build over time if it's not there on day one.
Excellent. Peter, switching it over to you, from SwissMarine, what are the opportunities you guys are looking right now, operationally and ownership-wise? What opportunities are you focused right now for the growth of SwissMarine from an operational and ownership perspective?
More investment. Historically, 95% of our book has been, or of exposure has been the next 12 months. The last few years, we're looking further ahead and we're trying to gain more long-term exposure. So that means either buying ships or doing more long-term charter. So we're lengthening our book effectively because we think there's certain opportunities in the dry bulk market.
And in terms of the financing opportunities to support your investments, you comment on the availability of financing.
We find raising finance on ship finance is not difficult. We tend to be fairly conservative in how much finance we put on, and we finance everything in Japan, and that goes very easily and very quickly.
Vagelis, turning over to you, and you mentioned in addition to your ownership side, the recycling part of the business. You want to comment a bit about that and how you approach it and how the interaction is with the ship owning side and the financing opportunities and how recycling impacts both?
Sure, yes. Thank you, Panos. So, from our perspective, we have decided to kind of, until there is definite solution on the fuel side at least and so on, we have heard all these arguments today, right? So basically, we have decided to invest more on the VITAT sides of assets. And basically, we're trying to apply the philosophy of reduce, like in the consumptions and so on, reuse the older assets and basically improve them in terms of the consumptions and their efficiency through efficient operations management, and eventually marrying this in a way with our expertise being the recycle to lead the units to a proper recycling manner as well. That's how it started, the whole story with Lila Global and the first assets being acquired a few years ago. Thereafter, of course, we have applied a policy, I think, that has been counter-cyclical, going back to your very first question. And I think we have been successful and lucky to a certain extent in that respect. Yeah, and we have done well there, for sure. Now, on your question about the recycling, I think there are a lot of developments taking place there on the regulatory front. We see those having implication to ship owners with questions being asked at the time of a new building, like how an asset is going to be recycled probably 25 and 30 years later on, with requirements from financiers to basically make that contractual obligations throughout the life of the ship until the unit is finally at the recycling yard. So yeah, it's a dynamic environment that we see a lot of changes taking place. Comparing to what it was probably 10 years ago, it's a totally different environment, infrastructure-wise, at the recycling facilities. They're adapting to the regulations on that front of the industry as well. So yeah, it's an interesting environment to be in.
And in terms of capital available, do you look for any outside sources for capital for the recycling business, or is that all proprietary capital that you guys deploy?
Well, we do from time to time, yes. I think the availability even on the vintage asset front has started becoming more easily. I think it was properly presented in the previous panel. It was properly said in the previous panel from the representative of Citi that basically through the past few years, basically shipping has made quite good money, I think. So allowing, giving lenders the confidence to invest in various segments there. And we've been seeing that. Yes, it's becoming more expensive comparing to probably some financing coming out of Japan, as was just mentioned, and so on, but there are options there.
Switching a little bit to the broader regulatory environment and coming back to you, Nicolas, both as a regulated investment manager and having vehicles that are listed, how does the broader environment with sanctions regimes and impact in investments through the geopolitical changes from terrorist attacks and the likes on vessels impact your both your investment decisions, but also the day-to-day management and operational of your portfolio?
So as you can imagine, we have a few people that spend a lot of time going through on the compliance side for our, in particular, the publicly listed regulated entities. It is, of course, our fiduciary duty in any way is to do that, but when it is even more so regulated and required by the appropriate authorities, we have quite a significant number of people that spend time to make sure that there is no, where does the vessel trade, that all the applicable rules and regulations are within what we are doing. So certainly, I think it is a practice, though, that even your banks before were requiring you to do in any case. So although we have traditionally been a very low leverage type of acquirer, so we have very low leverage on our fleet, and most of the time we don't have any leverage. If you want to make sure that you don't breach any of your other covenants or other that you're effectively operating within, it is something that you need to spend the time. And of course, it is very important that, especially for an investment manager, to make sure that they're not caught off guard. So we educate ourselves. We have people whose job is specifically that. And that, of course, adds to the amount of time that all the resources spend. But I think it should be the case. All the resources should be trained and to know what are the things that we can do and what are the things that we cannot do, of course.
Peter, your comment on the same topic a bit, like how do you protect yourselves from the global regulatory environment, the ongoing sanctions, and then the routes you follow for your vessels from the various situations?
Yeah, I was reflecting just on this. It's actually quite funny because it's not an issue anymore. Because in dry bulk, either ships trade Russia, in which case they're not on period anymore because the owner wants the premium himself, and the ships which are on period don't want to trade to Russia, because with us it's always the head owner, is he willing to go or not? So whereas in the beginning of the conflict we had a lot of big Russian customers and a lot of contractual business where we spent a lot of time figuring out what we could do and what we could not do. The last 12 months, it's a non-issue. I've not had to look at any sanctions issues anymore the last 12 months.
Yeah, I think the commentaries that here from me is that I would expect to see sanctions continue to be deployed and used as a tool by various governments to, address various conflicts. So today, or it's still Russia, tomorrow will be another state. So I think the technology and education in terms of analyzing what that means in a global business, it will definitely need to be there, but it will take different forms, obviously, going forward.
Well, obviously, we've had a lot of practice and have learned a lot in the first year of the conflict. All I'm saying is the last 12 months, for us, we've not seen it anymore.
And are there any other regulatory changes or that sort of impact your approach and analysis?
Well, we're all getting geared up now and starting to deal with the ETS, right, European Emission Trading Scheme. That has been the thing, setting up that properly, being able to deal with it, agreeing with all the owners retroactively on all the period charters, how you incorporate it, how you deal with it. That has been the thing we've spent time on the last 6 months.
Got it. Darren, in terms of the opportunities going forward, what do you see as the most exciting opportunities for an organization like yours, and how do you approach them vis-a-vis the companies also that you invest in and the opportunities that you approach? Do you look to partner with good operators, invest in good companies? How do you analyze the opportunities in front of you?
Yeah, our model historically has been start with distress and then see what the opportunity is, inject capital, build things, partner with good people. That's not going to change. There's always something to do. And, across, the various shipping maritime segments, it does seem that there is nearly always something to do. Sort of as I said earlier, we've really been focused more on offshore the last year and a half. We've invested both in PSV, OSV space and in rigs, principally because we see very low residual value risk. We see the opportunity to own tier 1 assets at fractions of construction cost, and the industry backdrop with basically no order books and this real sort of ESG constraints and investor distaste is really a good setup in our view. So that's really been our focus, and most likely will be where we continue to concentrate over the next few years until that industry normalizes.
In that same period, what do you see as the biggest risks for your exposure in the sector?
You've always got exogenous risks. So it's the unknowables. I think that's what we worry most about from here. But otherwise, from a cyclical perspective and from let's say a balance sheet perspective, we feel comfortable because of the prices paid and either the balance sheet or our control over the balance sheet. But it's really the exogenous event that always has me worried. The next COVID, the next whatever it might be. The good news is a lot of, shipping has this very peculiar characteristic that everybody in this room is familiar with. This industry often benefits from geopolitical events, from chaos, from conflict. We're seeing that, of course, now. But it is an interesting element from a portfolio perspective that I think is underappreciated outside of the shipping world.
And let me ask you one last question on that same theme. In terms of the financing opportunities for your investments, you utilize debt to support your investments in the sector, and if you do, how do you find the financing markets?
Yeah, it's a good question. We're generally very debt-averse people. We will borrow money against contracts, is generally the perspective. Debt is incredibly tight and expensive in offshore, even much more so than in shipping, which is generally supportive. You see, no real construction activity, 1 or 2 PSVs. Certainly no rigs are going to be built. The constraints of expensive financing are real, and they're very supportive. They're very positive. It means that you need much more equity. It means very few people can participate or play, and you have very little speculative activity. So this is a really healthy backdrop. It's a part of the reason that we're so positive on it.
Vagelis, over to you in terms of forward opportunities. Where do you see most of the activity for you, and some of the concerns that we've spoken about? How do they impact your business in terms of the regulatory sanctions regimes and so forth?
Well, from sanctions perspective, we are pretty clear. We are not doing anything that is not in line with the regulations. So basically, deep KYC in that respect and so on. I mean, you're laughing, but there are others that they're doing it right. But we are commercially oriented, but not so much. So sanctions, no, we are very careful with that. We have exited sectors because of the risk in that respect in the recent past. But definitely for us, there are going to be busy years coming up with the recycling, right? I mean, recycling remains our main business, our main focus there. It's been quiet over the past 2-3 years since COVID, basically, with everything booming. I think in the years to come, we're going to see busy times there again, and we remain focused there to be ready and geared up when that time comes. Now, on the shipping front, frankly, right now, I don't know what to tell you. I don't see something immediately. I mean, we are at the very healthy markets. I don't know to tell you where to invest or not to invest or disinvest, exits from somewhere. Everything seems very healthy. And I guess the geopolitical events will keep on having a big impact there. So I think because of the philosophy of our company being managing the risk basically always, right, and trying to have to monetize the right opportunities at the right time, being a privately held entity, we have this flexibility, right, the quick decision making. I think we're just going to be alert on that front to see what's the future holding for us.
Christian, I think in the past, in other industries, we've seen a much faster consolidation. I think shipping, despite a few deals that have taken place over the years, still remains a very fragmented business.
Yeah.
How do you view that, and do you think that could change? Is there going to be a drive for consolidation in the current environment with the regulatory regime, or a more highly regulated environment? Could that be a drive for consolidation?
Yeah, it's an interesting topic. I think if you take a step back and think about why consolidation happens in other industries, it's typically to gain more market share, which allows you to improve pricing, improve margins. It's about economies of scale. I do think that that's probably less so the case in shipping. I mean, if you go from 5 to 7% market share in a particular segment, that is not necessarily going to give you significantly enhanced pricing power. And putting together two companies is difficult. Different philosophies, and I'm talking about the shipping space, different philosophies, different operational teams. It is difficult. So you could end up with a situation where 1 + 1 doesn't equal 3, but it equals 1.8, and that's challenging. So I don't think it's at least from my perspective, a particularly big topic in the shipping space. I do think that organic growth in the growth segments is what is much more interesting. If you have an operating platform and you can leverage that platform to grow organically, that is interesting. Consolidation is I'm not saying it's impossible, but it's tricky.
And the private to public play, I guess, obviously for you, I assume private companies.
We in our fund we can only invest into private companies, and we've taken a number of public companies private. But this public versus private discussion there's no right or wrong answer. It really depends on your strategic objectives as a company. If you're public, it can be great. If you want to raise capital, if you want to create a liquidity event for the existing shareholders, but it can also create a lot of work for the management team. And there could be rationale in private ownership. If the market is mispricing your stock, you can't raise equity at appropriate valuations. Your management team is still very busy talking to investors, preparing reporting. So I think it's a case-by-case basis. There is no right or wrong answer, and that applies to all sectors.
Nicolas, as we're approaching the end, just wanted some closing remarks, and assuming we're doing this in 5 years from now, and you're looking back at your first 5 years at Tufton, where will the returns have come from?
First of all, Tufton has been really successful in managing money for investors over time, and it's about the long run, and that's what we're in for, because this is the industry that we specialize in. So that will not change. That will be the same, and hopefully we can continue the same performance that we had over the years. What will change is other themes and topics that perhaps Tufton has not done with regards to venture capital. We talk about the changes that we all want to see when it comes to the assets themselves, and some previous panelists mentioned the changes that also need to happen, perhaps at the hardware level, at the software level as well. And we see deal flow without even having a venture capital arm, and I think this is something that we will be spending some time on over the next 5 years, because innovation is important, and we want to contribute to that. And given that we have the industry specialization, we would like to do that. Otherwise, it's a question of growing the platform with more good people, because this is a people's business like any other business. Now, picking the right investments, we like chemicals. I'm happy to hear that Peter is getting longer, because we also like dry bulk, probably a little bit smaller, but we like the counter, if one can call it counter-cyclicality of it today, but we like it as well. And I like what Darren said too. I mean, offshore is something that traditionally Tufton has done, and it is a space that we also think is probably a good time to invest some capital in.
Perfect. And I think, Nicolas, you'll be pleased to hear the news that Tufton is launching a VC fund in terms of new activity. Peter, some closing remarks from you?
Okay. Why do we look for a longer profile? In the end, there's a big fleet built 2008, 2012, which will have to be replaced sooner or later. There's a lot of uncertainty on how you should be fueling it, whether these capital investment levels are still right. We think sooner or later there will be opportunities in that.
Is the fuel and changes that are coming in that respect going to be a big event for change in the industry, do you believe?
Why we see it more as something which will slow down investment to less than it otherwise would be, because there's this uncertainty. We think that might provide interesting opportunities.
Darren, some closing remarks and thoughts?
Nothing more to say. Listen to Peter.
Okay. Gentlemen, Vagelis, start with you. Any closing remarks?
Not really, but yeah, I mean, I can't disagree with everything that has been said so far on this panel. I mean, just a note, I think in continuation of what Peter just said on the Cape size, actually 2008, 2012, I think it's worth keeping an eye at the new building order book there, which is quite low. I think there are some opportunities there, probably for someone to consider. And yeah, I think it's going to be an exciting year ahead generally for all the segments of shipping. So let's see how it's going to go.
Thank you. And Christian, what sector will the next BlackRock investment be?
No, look, I think we're at what I would say is that we're at a critical point in time now, in particular from an energy transition perspective. And we need to be very careful around where you deploy capital. You don't want to end up with a stranded asset. But you also don't want to overpay for something that is hyped. So just finding that balance is not easy, and I think that requires thought with every investment decision. So it will be exciting and interesting.
Yes, Nicolas.
May I ask a question?
Go ahead.
Do you see more investors being interested to participate in private transactions rather than public vehicles?
Having just done a few rounds with our public entity shareholders, a lot of, so it's a Guernsey company. A Guernsey company is not for all investors. Some, foundations that are based in Europe do not and cannot invest in offshore jurisdictions. So some of our investors specifically tell us, we love your story and what you've done in the public markets. We want you to have private vehicles onshore, example, Luxembourg, and invest in. So that's an easy answer to your question, actually.
I should answer the first question, Peter says. No, it's actually a great question, and it's really interesting. Public versus private, and how do we think about that? Because we have done quite a bit of both. The issue that we tend to have with public companies is that the capital allocation tends to be pro-cyclical rather than counter-cyclical. On the other hand, private companies will trade at, by definition, private asset value or net asset value, whereas public companies, you can get discounts. What we try to do is we're really focused on residual value risk. There have been times where, for example, when we did a tanker joint venture, with some of our friends are in the room, where we acquired Aframaxes in 2018 just above scrap value. We couldn't create that in the public markets, and we couldn't have the negative control that we could have in a private transaction. On the other hand, there have been times when we can find wonderful management teams. They're rare, but they do exist, wonderful management teams, and you can create ships at an enormous discount, a couple $1 million. So those are very unusual, and you can never create those privately. So we try to be flexible, and we ask ourselves, what is the best risk-controlled position given a broad-based distressed? We set up a company in dry bulk because the public balance sheets were uninvestable in 2016. So we set up our own private bulk company with very low leverage to capture the distressed asset values. So those are just examples. I think it depends, it's the answer to most questions. And you just have to be thoughtful about what you're trying to do and how you're trying to control risk.
And you'd also have to be wary of your respective investment mandate and what you have undertaken vis-a-vis your investors. Because for some of these guys, investing in a public company may not be even feasible from a governance control.
Correct, yeah. I can comment briefly on the buying to companies, owning shares in companies versus just buying assets. Because we've done both, and we will continue to do both. What I would say is that if you're just investing into an asset, we will look for a narrow range of outcomes on the investment. I'll give you one example. We invested, and this is not in the shipping space, it's in the pipeline space. So we invested into Abu Dhabi's oil pipeline system. It's a joint venture with ADNOC. That is the way the investment is structured. It's a long-term agreement with ADNOC for them to essentially lease the pipeline from us. So the range of outcomes on that investment is relatively narrow because not that much can go wrong, assuming that ADNOC will continue to pay you. But there's also not much upside we can create. So narrow range of outcomes. When investing into companies with management teams, the range of outcomes is typically wider on the downside as well as on the upside. I think GasRock is a good example in the shipping space. We are not invested into the assets; we're invested into the top co, and that allows you to shape the strategic direction of the business much more. You can, for example, invest in new builds. You can sell older vessels. You have a seat around the table when these investment decisions or strategic decisions are being taken. Both work for us as a fund, and it's really about portfolio construction. So we have a bit of both in our portfolio across sectors.
Perfect. Thank you very much, all. Enjoy the drinks. Thank you.